CM is used first to cover fixed cost. Any remaining CM contributes to the net operating income directly, right? So above fixed cost, whatever is above the fixed cost, after contribution margin, whatever left after covering fixed cost will directly go to your net operating income. Again, I'm repeating this definition. I hope something rings in your mind what I'm talking about. After covering fixed cost, whatever left will go to operating income. What if we are not covering our fixed cost? What if our contribution margin is 70,000? We are not having any profit. What if our contribution margin is 80,000? We are having zero profit. So from here, so this discussion is basically coming out and after like some couple of slides, but just I'm going to give you a little bit wake up call here. So when our CM is equal to fixed cost, our net operating income would be zero. So when our profit is zero, what does it mean? Sale minus cost is equal to zero. We call this situation break even. So we have different formula for break even as well, but remember, this is the logic as well. If your CM is equal to your fixed cost, you see, if 80,000 should be here and 80,000 here, answer would be zero. So this is the importance of contribution margin, and that's why the managerial accountants, they focus more on contribution margin statements rather than the financial statements, because financial statements are made according to the law, according to the GAAP, generally accepted accounting principles for outside users. So they give us meaningful information for other outsiders as well, but for internal purposes, they make income statement based on contribution margin format, right? So that they just by looking at the statement, they know that, okay, how much is our break even, how much is our, how much is our profit is going on, what if we increase the price, what's going to happen. So they just going to simulate on the basis of volume, profit, or cost whatsoever, right? So this is a small formula. Sale minus variable cost is equal to contribution margin, but it gives you too much information. Let's just talk about further. So we can also find out contribution margin on the basis of per unit as well. Why? Because the nature of contribution margin is variable. Why? Because if we increase the number of outputs, the contribution margin also increases. If we decrease the number of output, contribution margin in total also decreases. But in per unit basis, it remains the same. So we can trust this per unit figure as well. So sale, variable expense, and contribution margin can also be expressed per unit basis. So if the racing sells an additional 200 bicycles, so it means 200 basically CM is going to be generated. So how we are going to use this contribution margin? I think it's going to be, this question going to be answered in coming slide. So that concept that I was talking about, the break even. So here we go. So each month we have to generate at least 80,000 contribution margin in order to earn zero profit. So when your total sales is equal to your total cost, that is the point we call this break even. So it means after this point, we are making money, and before this point, we are having loss. So how we want to find out the break even? Just rearrange this equation. Sale less variable cost is less fixed cost is equal to net operating income. And you will find out that if we put 400 here in number of units sold, then we can find out exactly 80,000 contribution margin, which is equal to the fixed cost, and then we will be earning on break even point, zero profit. So if you are selling 400 units, selling price is 500. So 400 into 500, answer would be 200,000. Now the question is where this 120,000 came from. So we know from here that we converted our variable cost into per unit cost. So our variable cost is 150,000. Number of units we are selling 500. So that's why we have 300. So if we increase or decrease the production, that 300 remain the same. So that's why we are counting on that one. We trust this figure 300. Now we are selling 400 bikes. 400 multiplied by 300, answer is 120,000. And now we are having 80,000 contribution margin, and 80,000 is our fixed cost. We are earning zero economic profit, right? So one formula of break-even point can be using contribution margin approach. That's contribution margin is equal to fixed cost, right? So from here, we learned our two formulas. Number one, contribution margin is equal to sale minus variable cost, right? And it's applicable for both in total sales minus total variable cost. Then we find out the total contribution margin, like 80,000 total contribution margin. And if you want to convert it into units, and sale price price per unit minus variable cost per unit is equal to per unit contribution margin. And then we learned the break even, and then we talked about break even is equal to total contribution margin is equal to total fixed cost. So why we cannot convert total, why we cannot say that total, why we cannot say that CM per unit is equal to per unit fixed cost? Because the nature of fixed cost is that it changes with the level of output here. If we increase the production, the per unit fixed cost changes. So we cannot say for sure that this condition holds for break-even point. So we measure the break-even point in contribution margin approach in totality. So let me ask Arone, Christine, David, Sipati, Min, Chandra. Understand?
Yes.
After what we have discussed, you understand that?
Yes.
Yeah.
Good. It means we are going on the right track. Okay, so now how we use this contribution margin approach in a matter of seconds to find out what would be our profit. So we know that our break-even point is 400 bikes, right? So in selling one bike, we are earning 200 contribution margin, right? So now, what is the second definition of contribution margin? After covering fixed costs, right? Whatever left directly goes to net operating income. So we sell one car, and one car is giving you 200 contribution margin. So that 200 directly goes to net operating income. So you know that your contribution margin is 400. You sell one more car. One more car means your per unit contribution margin is 200. 200 is your profit. What if you sell 10 bikes? Then 10 multiplied by this 200, 2000 is your net operating income. So you don't have to make the complete table, the complete income statement. It's out of your finger. All you need to do, just you need to make the break-even statement. So you find out the contribution margin in total terms and your fixed cost. That's it. And you know that this much you need to sell to cover your fixed cost. And after that, whatever the unit you sell, multiply it with contribution margin, and that is your profit. What if you sell 20 bikes more than your break even? So 20 multiplied by 200, 4,000 is your net operating profit, right? So this is the ease of understanding the contribution margin approach. So that's why the managers are fond of this approach to make income statement. So, like I told you, let's read that. This is the same concept that we just talked about, but written in a very nice way. Sorry about my handwriting is not that good. So we do not need to prepare an income statement to estimate the profit at particular sale volume. Simply multiply the number of units sold above the break even. You will find out the contribution margin per unit. So if racing sells 430, which is above 400, how much? 30 units. Your contribution margin is 200. 6,000 will be your income, right? Now let's develop the equation, the relationship of cost, volume, and profit. So tell me, are you fully aware of the concept of contribution margin? David, Sipade, Chandra, Min, Aroni, Christine?
Yes.
Please. No more question regarding contribution margin, right?
No, I guess how it works, sir.
Good. I hope you outperform in exam as well. Good. So let's talk about the equation. So we know that profit is equal to sale minus total cost. Total cost include variable cost and fixed cost, right? So sale minus total cost. Total cost include both fixed cost and variable cost, right? I think let me. So we know that profit is equal to sale minus total cost. Total cost include variable cost plus fixed cost. So if you open that one, fixed cost plus variable cost, and if this is the basic mathematical profit, basic mathematical equation. So minus is outside the bracket, so it would be sale minus fixed cost minus variable cost is equal to your profit. So we know that